Hello guys, welcome back to our channel. What's up? When you're just about to venture into the business world, it's best to equip yourself with all the terms and techniques beforehand, so you don't feel like you're lagging behind. So in today's video, we're going to tell you about the two most important categories that appear on a financial balance sheet. Let's look at assets versus liabilities. What's the difference? What is the simple difference between assets and liabilities? The simplest explanation of these two categories of the balance sheet is that assets are those items that any company owns. These items can prove beneficial for your economic plans. So assets are useful for any company in the way that it adds to its worth. On the other hand, liabilities are those that a company owes to other parties. In this way, liabilities don't add up to a business's value, but on the contrary, decrease the company's equity. So simply put, assets add money into your pocket and liabilities empty your pockets. According to the reports, while liabilities present a future obligation, an indicator of a successful business is one that has a high proportion of assets to liabilities, since this indicates a higher degree of liquidity. These two determine the financial health of any business, and a greater number of assets than liabilities are an indication of strong financial health. Another important thing that everyone should know is that some assets' value diminishes over time, while the same could not be said for liabilities. Assets and their examples. As we just explained, that assets cover all the resources of a business, be it tangible or intangible, and it helps to increase the company's equity and meet its commitments. Let's look at the example of assets. A few great examples of assets include the company's vehicles, cash, inventory, real estate, investments, machinery, and office equipment. What is assets liquidity? Just when you thought we were done with our explanation of assets, right? Assets also have further categories. They're divided based on one important quality, their liquidity. In other terms, liquidity means how fast an asset could be turned into hard cash. Cash is considered to be the most liquid asset that you will see on your balance sheet because of its immediate availability. Cash could be immediately used to pay off a company's liabilities. The opposite of liquid assets is called an illiquid asset. This includes secondary items to cash, such as a company or a factory. It is called an illiquid asset because if a person wants to earn cash with this asset, he will have to go through a lengthy process of selling it. Current assets. Some assets are known for their extreme liquidity, and those assets are called current assets. Such assets could be converted into cash in very less time and help generate revenue for a company. These assets include accounts receivable inventory, marketable securities, and also cash, of course. Fixed assets. All the non-liquid assets or liquid assets come under the umbrella of fixed assets. Its examples are vehicles, machinery, and real estate. According to the financial reports on balance sheets, fixed assets are owned by your company and contribute to the income, but are not consumed in the income-generating process and are not held for cash conversion purposes. Fixed assets are tangible items usually requiring significant cash outlay and lasting for an extended period of time. Liabilities. Liabilities, as we already told you earlier, include all the money that comes out of your pocket in business. But a much broader explanation, as per the report, suggests that liabilities are your business debts and obligations, which you need to fulfill in the future. This is the money you need to repay, the goods you need to provide, or the services you need to perform. These responsibilities arise out of past transactions and need to be settled through the company's assets. Current liabilities and their examples. Liabilities are also further divided into two groups. One is current liabilities and the other is called non-current or long-term liabilities. Those liabilities that are due within the present year are called current liabilities. These include money owed for operating expenses. As one source explains, if you have a 30-year mortgage on your building, the next year's worth of payments owed will be listed in the current liabilities section. But the remaining amount will be shown in the category of long-term liability that we will discuss in the next section. For now, let's look at the example of current liabilities, which include accounts payable, money that your suppliers owe, sales tax, short-term loans, band overdrafts, wages owed, payroll taxes, and income taxes. Long-term liabilities and their examples. Long-term liabilities, also known as current liabilities, are a type of financial duties that you don't have to pay within 1 year in a business. The time period could extend. Its examples are capital leases, long-term borrowing, bonds payable, mortgage debt, notes payable, financial securities including bonds and stock shares, pension liabilities, deferred taxes and pensions. Both assets and liabilities are an essential part of a company's balance sheet as they determine the financial position of any business. So any person, whether a small businessman or a big one, should have a solid grasp of the concepts of assets and liabilities, and should take into consideration both while balancing business sheets. Only then will you be able to evaluate your financial position wisely and make better decisions. This brings us to the end of this video. Tell us what you guys think in the comments section down below. If you liked this video, give it a huge thumbs up. Also, make sure to subscribe to our channel, and don't forget to hit that notification bell so you never miss out on any of our upcoming videos. Until the next one, take care and goodbye.